Okay, this is question Amberle Company. This is actually your past exam paper. If I'm not mistaken, this is December 2018 question. A very typical and interesting question for APV. So when you see a long question, of course, any long or even short, I generally would prefer to go and first see that what is the requirement. It says calculate the adjusted present value APV for the project and conclude whether the project should be accepted or not. So, it is good to first read the requirement because you have to read a lot, a long text. So if I don't know what is the requirement, my reading is not objective. I don't know why am I reading the question. So it is better first to, establish in your mind that what you are supposed to do with this information so that in your mind you can highlight or pinpoint some important data which is going to be used for the APV calculation. Okay, so this is an APV question. Number one, it says that calculate the adjusted APV for the project and conclude whether the project should be accepted or not. So you have to give a conclusion as well. Then there is part B, which says discuss the factors which may determine the long-term finance policy which Amberle Company's board may adopt and the factors which may cause the policy to change. Now, there is a very fine line. I can make this question very easily an academic question or a scenario-based discussion. For example, discuss the factors which may determine the long-term finance policy. If I remove the word Amberle, now it becomes an academic question. And you have to go to the book and start thinking about like what are the long-term financing policies in general. But when they write down here Amberle Company, so it means that you don't have to do a lot of effort because generally the principles will remain same. But what you need to do or what you're expected to do is that you should be making reference out to the name Amberle Company. Okay, so that it looks more specific discussion. And besides, of course, within the given scenario, you will also make some references. So we'll discuss this part B strategy little later. We start with the first part A, which is APV calculation for 15 marks. Now, before I begin, we have discussed this thing in the previous sessions, and we have also put video lectures in detail. What is the difference between NPV and APV? So for APV, what do we do? First, we calculate the project NPV using the cost of equity, because we say that it's an ungeared company. And then we say, as a result of introducing the debt, APV we calculate when there is a significant debt component, huge debt is involved. So first we discount the cash flows with the cost of equity, not with the VAT, but with the cost of equity. And we see the result, and that is called basic NPV, which is based on your cost of equity only. And then you say, okay, if I add debt into this project, so what benefit am I going to get? So maybe there is a subsidized loan. So that benefit I will receive. Then if I take the tax shield on the so one benefit will be the reduction in the interest rate. If it is a subsidized loan, so normal loan from a bank is 8%, but I'm getting it at 4%. So that 4% is the benefit. This is interest saving I have. Then there is some issue costs, which is a negative thing that we must include. Then maybe there is some standard normal debt, the cost of debt and the benefit, the tax benefit on that. So primarily it is about the tax benefits on the debt, because this is what the debt brings in. So the tax benefit on the debt, plus if there is any interest saving because of subsidized loans, that is included. And of course, if there is some cost of issue, that is the opposite thing. This is going to be a cost. So the basic NPV plus minus these changes, we conclude this thing. So I know that this is a scenario. So if it is an APV thing, I'm expecting some significant financing component. I'm expecting some issue costs already in my mind. I'm expecting some tax savings on some subsidized loans. and interest saving on some subsidized loans and so on. So these things are already in mind. And then you start reading the question or the information. So you are actually, kind of more objective reading you can do. So we start with here. Amberle Company is a listed company with divisions which manufacture cars, motorbikes, and cycles. Over the last few years, Amberle has used a mixture of equity and debt finance for its investments. However, it is about to make a new investment of $150 million in facilities to produce electric cars, which it proposes to finance solely by debt finance. So that comes in. The first expectation is met. That I thought that there is going to be a significant debt, maybe 70-80%, but they say it is only debt financing. So currently they have equity and debt together. Project information, Amberle Company's finance director has prepared estimates of the post-tax cash flows for the project using a 4-year time horizon together with the realizable value at the end of the year. By the way, one comment here, 4-year time horizon, the cash flows. And they want to calculate the NPV based on this 4 years. Now, this is going to be a big investment, and it's an electric car. I don't think that the project should have a life of 4 years. The cash flows, there should be some cash flows here as well, which they have not given. So I keep this in my mind because it surprised me that if you are investing $150 million in an electric car manufacturing facility, why do you expect to recover this amount within 4 years? It might have a longer time period and some other cash flows as well. So this, of course, I'm not going to include it into my calculation because I don't have the numbers, but I will keep it in my mind as part of my discussion that whenever I will be given a chance, I will point out this issue that, that seems a bit strange. So this is post-tax operating cash flows 28.5, 36.7, 44.4, and 50.9. Cash flows are increasing. So what do you think in year 5, how much it is going to go? Again, if the cash flows are decreasing, I would say that, okay, in year 5, the project is rolling back because cash flows are decreasing. Maybe market is finishing, so I can roll back. But they are actually increasing. So I expect this project to have a longer period of life. This is just a general discussion about understanding, okay? Another thing, they put realizable value as 45 million, which is almost like 30% of the initial investment. And that is going to be a big question because in NPV, APV questions, whenever you do, you always, as part of the discussion, you talk about the assumptions based on which you produce that NPV. And by the way, this is something which is a very challenging thing that they expect that they will sell it for at the 30% of its cost, which is pretty much more. Working capital of 6 million, not included in the estimates, which means that this 150 million does not include working capital. It is a separate number in the estimates above and funded from retained earnings. So you are not taking a loan for that. So they said it is debt financing. They told you that it is from retained earnings, okay? If they told you that it is not from retained earnings, then your total requirement should be 150 plus 6. Then you will go for the loan for this amount also. But here it says they will provide it internally. So this is not part of the debt financing. It will also be required immediately for the project. Rising by the predicted rate of inflation for each year, any remaining working capital will be released in full at the end of the project. That's very normal. All of the working capital comes back in the last year, but working capital requirement will increase every year by 8%, 6%, 5%, and 4% based on the inflation. So this is also pretty normal thing. We expect this type of data or information in such questions. So nothing unexpected. The finance director has proposed the following finance package for the new investment. Bank loan, repayable in equal installments over the project's life, interest payable at 8% per year. So you are going to take 70 million in the bank loan, subsidized loan from a government loan scheme over the project's life on which interest is payable at 3.1% for 80 million. Okay, so that is pretty much simple. You need 150 million and you are going to take 70 million from the bank at 8%, and you will take 80 million from the government at 3.1%. But there is one thing which you need to pay attention to, that this bank loan is repayable in equal installments. So you need to prepare a table for interest expense, because you cannot say that, okay, 70 million is my loan and I'm going to pay 8% straight. No, because you are paying back the loan year over year. So every year your interest payments will decrease. And this you have to calculate. How much is the equal payment? This is part of your financial management fundamental course, how to calculate annuities or equal amounts with interest rate. The very simple formula is, I'll tell you now, if there is a 70 million, plus I have to pay interest, and I want to pay it back in project life, which is 4 years. So how do I know what is the amount of equal interest? I mean, if it is 70 million, I don't have to pay interest. Then you can say 70 million divided by 4. But it is 70 million plus interest as well. And then you have to pay one single amount that will include the principal and interest, and it will close in 4 years. What is that equal amount? So the formula here would be, you will just divide it with the annuity factor of 8% for 4 years. Loan is for 8%, right? Yeah. So 8% annuity factor 4 years, you will calculate, divide it, it will give you one number. This is going to be your one equal installment, 1, 2, 3, 4. So this is basic knowledge, but you have to pay attention. But you are not expected to do the same thing for the government loan, because it says that the government scheme over the project life on which interest is payable per year. So the government loan, you might have to pay in the end lump sum, but every year you will only pay 3.1% interest. So for this calculation will be easy. Okay. So these are little things which you have to pay attention to while reading the question, okay? Because so that you make your plan of action or strategy in mind, what to do, which type of workings I have to produce. Financial information. Amberle company pays tax at an annual rate of 30% on profits in the same year in which profits arise in the same year. We know that taxes can be paid next year. When they pay taxes next year, you have to add one more year in the end for the last year tax. But here they pay in the same year, so life is easy. Amberle company's asset beta is currently estimated at 1.14. Now remember that currently they have here this thing. It's a mix of equity or debt currently, their capital structure. Now this is very interesting to understand, okay? Very important point coming in. Because I know that sometimes you see the solution at the end of the book and you say, okay, this is the only way, this is the way book has done, and you start solving it. And then in the exam, they change the scenario and you don't understand those fine, that subtle differences, which would actually could have changed the calculation. So please pay attention to this point. Amberle company's asset beta is currently estimated at 1.14. The current return on the market is estimated 11%. The risk-free rate is 4%. Why they are telling you? They are telling you so that you can use your CAPM and calculate the cost of equity, because we said that in case of APV, we have to first calculate the NPV based on the cost of equity only. So for CAPM formula, KE is equal to RF plus beta into RM minus RF, okay? So our risk-free rate is 4%, beta they have given us 1.14, and this is 11%, the average return, and this is 4%. So I can say that 4% plus 7 into 1.14, 7 into 1.14, 7.98, it is 8% approximately. So my cost of equity is 12%. Now, what I was saying that you have to pay attention to. You know that they currently have a capital structure which is a mix of equity and debt. If they tell you that Amber Company's beta, if they had told you that Amber Company's beta is 1.14, or I mean, let's call it 1.45. If they only use the word beta, it means that this is a geared beta. And you need cost of equity for an ungeared company. So then you could not have used that beta. They told you that Amber Company's asset beta, they told you. If they don't say asset beta, if they don't say asset beta, and they say Amber Company's beta is 1.14 or 1.2, whatever it is, then you know that that's a geared beta. That's a geared beta because they are using a mix of equity and debt. In that case, you have to ungear it. And how to gear ungear beta, we have done it in last session. Okay, I'm very safely, freely using this beta in my straight into my calculation because they told me that this is asset beta. If they had not told us, if they don't use the word asset beta, then they also would have told you that their current capital structure is 60-40 or whatever. So you know that, okay, the current beta, which is the geared beta, it is based on 60-40 capital structure. And if I have to ungear it, I have to remove that part of the debt and then see how much it is. So please pay attention that if, okay, I mean, here in this question, like I said, that the examiner or the question, whoever he has set up this exam paper, he has been very kind to you. He has been very kind to you. I probably, if I had drafted this question, I would not have given you asset beta. I said beta is 1.44, 1.44, and capital structure is 60-40. Now go first find ungeared beta and then put that ungeared beta into this calculation. So pay attention to these little things, okay? So it's not just beta, it's asset beta. It has already been ungeared. So you can call it, it has already been ungeared for you, thanks to the examiner. Okay, Amberle Company's chairman has noted that all of the company's debt, including the new debt, will be repayable within 3 years to 5 years. He is wondering whether Amberle Company needs to develop a longer-term financing policy in both terms and how flexible this policy should be. Okay, so this is not actually related to part A. We are going to use this information while answering part B. It says chairman has noted that all of the company's debt, including the new debt, will be repayable within 3 to 5 years. Oh, 80 million of new debt and then something of old debt. Everything has to be paid within 3 to 5 years. So they are into short to mid-term. They don't have a long-term debt because long-term is 5 years and above. He is wondering whether Amberle Company needs to develop a longer-term financing policy in both terms and how flexible this policy should be. Okay, we'll address this thing later. Okay, there is one more thing which I am looking for. Do they not have any issue costs here for the subsidized loan? Generally, issue costs are also in APV question, but I didn't see that. I didn't see that. Because generally they add it. 3.1% is the loan. Okay. Tax is there. This is there. This is there. If I just change this thing with percentage because I wanted to make it bigger. So if I make it bigger, it appears here. You see here. Issue cost of 3% of gross proceeds. So there are 3% issue costs. If I don't know why it is doing this thing, if I make it smaller, it disappears. If I make it bigger, it appears here. Issue cost of 3% of gross proceeds will be payable on the subsidized loan. No issue cost will be payable on the bank loan. So bank loan does not have issue cost, but the government subsidized loan, it does have issue cost. And very interestingly, what you need to do, that issue costs are not allowed for tax. So you don't get a tax benefit on that. So when you have issue cost, what does that mean? You are looking for a loan from the government for 80 million. Okay. So if you raised 80 million from the government, 3% is going to be the issue cost, which is like 2.4 million. So, okay. So it means that you in the end will receive only 77 million and 600. 77.6 million you will receive, but you need 80. So it means that you have to raise more than 80 million so that after paying for the issue cost, you are left with the net amount of 80 million. So you have to raise more. So how do you do that? You say that this 80 million is actually the 97%. So you divide it with 0.97. Okay. And whatever the number will come, 82, 4, 5, or whatever, that would be your actual amount which you have to borrow, which you have to raise, okay? And you have to pay interest on that amount. So let's start doing our calculations. Now, I want to make it a little bit smaller. Okay, if I make it small, then it is okay. Then it is okay. I think it was made bigger. So this is a very typical question and for APV. And we start with creating our standard NPV calculation table. We have done this many times before, but we will do it again. 1, 2, 3, 4 years. And here this is year 0, you can call it. So you have 4-year timeline. Because the tax is paid in the same year, so you have to make 4 years. If they say that tax is paid next year, then you have to prepare year 5 as well for getting the tax calculation, because then year 4 tax will be paid in year 5. So you need to add 1 more year. But in this question, it says in the same year. So I've got here then what I need to do, I need to put the numbers. I'll put, like in all of my questions which you have watched, we don't put 60, we put 3 zeros at the top, so that we say that, okay, these are in millions, but we don't have to put so many zeros. And then you have your initial investment, and that is made in year 0, which is 150 million, and I'll put only 3 zeros. So when I put 150 with 3 zeros are on the top, that makes you 150 million investment. You have your operating cash flows. This first table is going to be very simple, okay? But of course, you need to be very proficient in making this thing. 28.5 million. So when they say 28.5 million, I can put the number 28,500. Then I have 36,700,000. I've got 44,400,000. By the way, there is one more idea, and that will save you from some kind of confusion. Try to use the data as they have given it in the question. Otherwise, sometimes, because when you are making the answer sheet and then you go back to the questions, you get confused. They say 36.6, I wrote 36,700. Is it going to create some problem? So many times they will put numbers here, like they will say that, okay, these are in 3 zeros, and then they put 36,700. So this is mostly I do, and this is mostly they also do in exam. But this time I say that they don't put 3 zeros. They said that these are in millions, and they use 28.5. So it is better to follow the format which is given in the question sheet, so that when you make comparisons, you don't get confused. So instead of putting 3 zeros, I will also put that this is, dollars in millions. Okay. So this way you can, otherwise sometimes you will get yourself confused. Let's put it 150, and this has to be minus 150 actually. It is outflow, and this I put as they have given us 28.5, 36.7, 44.4, and 50.9. This is your operating cash flows, which you are going to receive. Then you have here realizable value, which is also called residual value, which you will receive by selling this equipment. And this is also a positive cash flow of 45 million. And here you need to put, there is no other fixed cost, variable cost or something, but you need to put working capital, okay? So working capital requirement you have to add. When do you add it? It says 6 million. So this 6 million you need to have right at the beginning of the year one. When you start your project on very first day one, you need to have this 6 million. So it means that this 6 million goes here in year zero. It is not for year one, it is for year zero. Okay. So this 6 million, you will put it as here in year zero. But then you need to make here some workings. I'll make working one. And I call it working capital because working capital is going to increase with inflation. So what happens that you have put your working capital initial, but that is not enough. So you've got in year zero, 6 million, which is available at the beginning of year one. But then you need to increase this working capital requirement every year with the inflation rate. Here I've got some inflation. I'll just write it down for the sake of simplicity. 8%, I've got 6%, I've got 5%, I've got 4%, okay? 4%. So working capital is going to be increased 6 times 8%. So 0.48. So you have to add 0.48 in this year as well. This is what is going to happen with working capital into -1. This is again cash outflow. Then you will do in this year, what will happen now in the beginning of year two, you will have these two numbers, 6 plus 6.42. So you've got 6.48, and this is going to be increased by 6%. So I'll say 6.48 times 6%. So an additional requirement in year two, you have to add again 3.88 million of working capital. And then it goes in year three, and it goes in year three, and it goes in year three. That's all. In the beginning of year four, what do you have? You've got 7.21 million. And you don't have to increase it. Actually, you are going to get back this working capital. And this is going to be a positive number. So what it means that you have invested in working capital in these years. So let's put it 2 decimal places. So 6 million I put in the very beginning. 0.48 million I will invest in working capital in year one, then in year two, then in year three. And the sum total of all these is 7.21. It will roll back at the end of the project, which is 7.21. Now, these are the only cash flows which they have given us, and we make a total here. And just use this format. So this one and the present value. Oh, no, not the present value. I have to add the discount factor now. So here we need discount factor. So we have to discount factor, and I will mention here is cost of equity. And I don't know cost of equity. So I need to do my second working two for cost of equity prior to the project or existing cost of equity, what you may say. And this is using CAPM. And I have explained you that they gave you this beta, which is already, where was the beta given? Asset beta. They told you that this is the asset beta is 1.14. So you will use it straight away. So you will say that KE is equal to RF plus beta times RM minus RF. Okay. I think it was 12%. We already calculated it. So I'll put it here as 4% plus 1.14 times 11% minus 4%. Okay. So I explained you that you need to have that. It's an ungeared beta. They already told you, so you can use it freely. It is 11.988, and I can say that my cost of equity, which is working to 12%. Okay. So if it is at 12%, I have to discount them with 12%. Year zero factor is always 1. I can show you with the formula 1 divided by 1 plus 12%, 1 plus 12% and power 0. This is 1, okay? And these are my next year's, and present value will be this times this. And you've got here NPV, which is equal to which is 5.5 million or whatever is negative. So I've got here a negative NPV of 5.147 million. If the project is funded by 100% equity, this is called actually, let me call it basic NPV. Your basic NPV is 5.147 million negative, and this is very much expected. In APV questions, usually your project is giving you a negative NPV with cost of equity, and then you will add the impact of financing. The financing impacts you have to add. So what are the financing impacts we need to calculate? So if we say, okay, if we finance it ourselves, that's a project not worthwhile to do. But if we add that equity and debt thing, so you've got 150 million of debt. So what you are going to get, you will get tax benefit on bank loan, tax benefit on subsidized loan, interest saving on subsidized loan, and you will have 3 savings, and then you will have your issue costs on subsidized loan. So these three things are going to be benefits for you. They will improve your NPV, and this is going to be a cost for you, issue cost. Okay. Are you clear? If you want to ask something until here, please. Okay, I'll start. So first, let's see what you need to do. You need to do debt financing. Debt financing, bank loan will be at 8%. It is going to be 70 million. Subsidized loan, you need 80 million. You've got issue costs. Issue cost on subsidized loan, which is 3%. So it means that gross subsidized loan, because you need 80 million for yourself net. So if you take 80 million from the government and 3% you spend on the issue cost, you will only end up with 77.6 million and you will fall off cash. So what you need to do, you need to divide it with 0.97. So your net amount which you are going to get or which you want to borrow is actually 8.42 million. This is what you need to do. This is how it will look like. So 82.47. So this is here, and then I say my issue costs. How much are my issue costs? Issue cost will be this 82.474 minus the gross amount, net amount which you will receive. So 2474, this is a number which I need for my calculation. So issue cost on subsidized loan will be this much. 2.4 million is straight my cost. And that is actually, if I have to put it, I have to put it into minus, because that is something which I would say a negative for me. This is going to further negatively impact my current NPV, because this is something which is an additional cost by taking the loan. Now, how much are the tax benefit on the bank loan, the tax benefit on subsidized loan, if I talk about like this? So tax benefit on subsidized loan, this is issue cost. I don't put it in black and I put it in yellow. This number I need it. So how much is my tax benefit on subsidized loan? So how much loan are you going to take in subsidized loan? I'm going to take 80 million loan, because remember, you are actually going to take 82.474 loan. But I'm going to use number 80 million. Why I'm using 80 million? Because I'm calculating the tax benefit. And the question, it says that there is no tax benefit on the issue cost. You see that? It says that issue costs are not allowed for tax. And therefore, I'm taking 80 million because this is without issue cost. Okay, so I have this number, tax benefit. So I would say that how to make it presentation. I can make it longer, I can make it shorter. 80 million is there. Tax shield. So tax shield, you pay on the interest, right? So how much interest you are going to pay on that? It is interest you pay on this amount, 3.1%. Okay, this 3.1% you pay interest. On that interest, how much is the tax benefit? The tax benefit is 30%. This is, if you understand these three numbers, 80 million of loan. On loan, I pay 3% of interest. So this first two numbers will make my interest. And on interest, I get the tax benefit. But then this tax benefit, for how many, do I get it for 1 year? No, I get the same amount every year, because you don't have to return back the loan. So you are paying the fixed interest, 3.1% every year of the same amount, 80,000 every year. You are not returning the loan. So your loan liability will remain 80,000 for the 4 years, and you have to pay 3.1% every year, and that will give you the interest amount. And on that interest amount, when it goes to income statement, it brings you 30% tax benefit. So I have to multiply this number with my annuity factor. Okay, so let me make my annuity factor. Annuity factor. Annuity factor. So year 1, 2, 3, 4. Now, annuity factor means that I'm discounting it. So what I'm going to do, actually, okay, let me show you the numbers, okay, so that you don't get confused. You will get 80,000 is your loan amount, 3.1% is your interest. So what is happening, that you are actually paying 2.48 million interest every year. So 2.48 million in year 1, this in year 2, this in year 3, and this in year 4. Okay. So either you take these 4 and then you discount them and find out their present value. One way of doing it, okay, this is my interest saving every year. So what is the discount factor? You can go for the discount factor and make this table. Like I said, that should I go for quick calculation or should I go for a long calculation? Long calculation, I should make like this. Okay, I'm saving this interest. This is the interest I'm paying on this loan, 3.1%. And on this, I pay the tax 30%. So this is the interest cost. This is 30%. And then you start calculating, okay, this interest into this one. So you make it 4 years. And then you find out the discount factor because you have to find out the present value of all of these. So then you add the discount factor. So instead of doing this 4 discount factors, what you do, you make your one annuity factor. So I'll say equal to 1 divided by 1 plus 8%. And I would say power 1. And this 8% is E, and I'll make it F4. So I'll lock it. And here we'll say that this is this much. This factor is this plus this. So I made this 4 years factors, and then I made 4 years discount factors. And this is my annuity factor, 4th year annuity factor. Okay, 8% 4-year annuity factor. Now remember that this is a subsidized loan. Now this is a question which sometimes students they ask, and if I'm not mistaken, this question was raised in the last live session as well. That should we discount this subsidized loan and the benefits on that on risk-free rate, on interest rate by the government, or on the cost of debt? And I gave this answer, please do it at cost of debt. Even if you discount it with some other rate, examiner will allow you marks. This is what I told you last time. Because it's not computer checked, it's manually checked. So examiner will allow. But better is that you discount it with 8%, which is your cost of debt. So I multiply it with 3.3121. So when I make a total of this number, I get here 2464. And this 2464 is the second thing which I need. This is my tax benefit on subsidized. This is the present value. This is, what is this? This is the present value of tax benefit collected on subsidized loan over the 4 years. So if you are clear on that, please give me a sign, I'll move forward. This is the second number I need. I said that we need these 3-4 items, okay? So interest, so tax benefit on subsidized loan, we have calculated. Where it is? This one. This is a positive number. So we employ this loan at 3.1% and we get this thing. Then we have to calculate tax benefit on the bank loan. Now, this calculation will be slightly different for the bank loan. If you have any question, please ask me.
No.
It's clear?
No, sir. In this question, they have told us that the issue cost is tax-free. But if in the question they are giving us that issue cost is tax allowable, then should we use the gross up amount?
Yeah, if it is tax allowed, then but you would not do it because you know what, issue cost, you do it only one time. But this thing is happening every year. So I cannot make it 8244. I cannot make it 8244 because I'm not paying. Yes, no, if I have to, issue cost is taxable, then you have to add 82 full amount. Then you have to add it 82 for it. So tax benefit on bank loan. Okay. So first you need to find out that your bank loan amount, how much it is. It is 70 million. Interest rate is 8%. Your annuity, 4 years annuity factor is this one same. So my annual payment amount. So like I said that you have to pay equal amount. So this divided by this. So you have to pay 21.1 million or whatever it is every year. Okay, so let's make year 1, 2, 3, and 4. We'll make some calculation. So I have here 80,000 my opening balance. Then I add interest, which is 8%, 80,000 into 0.08. And then I will say my payment, which I will pay equal amount, 21 into -1. And this is going to be my closing balance. So we are making an amortization table. And
There isn't the loan amount opening balance 30,000.
sorry, 70,000. Yeah. Thank you. Okay. So this comes here. And I'll make a copy paste. And why these numbers? It should become 0. Oh, okay. So N56 into 1, 456. What is N56? Is taking interest here. So F4. So you see your loan becomes 0. So these are your interest amounts which you will pay. These are the interest amounts which you will pay over the bank loan. In the bank loan, you are, see, here I did one number because you will pay equal interest, 3.1% on 80 million for the next 4 years. Because the question says that the subsidized loan, you don't have to pay back anything during the life. You will only pay interest in the next 4 years. So my interest amount is equal. Because it becomes equal, so I call it an annuity. If my interest amount becomes equal for the next 4 years, I call it annuity and I use the annuity number. But in the bank loan, what is happening that I have to repay the loan every year equal amount. How much is that equal amount? That equal amount is 80 million or 21.134. And as a result, if you see that this calculation is correct, so end of the year, your entire loan is paid back. Now, this is the interest which you are getting. Now, you are going to get some tax benefit on that interest, okay? Tax benefit on interest. How much of that tax benefit? 30%. So this times 0.3. So this is the tax benefit you are getting. And then this tax benefit you're going to get in year 1, year 2, year 3, year 4. You need your discount factors. Which discount factors? 8% we use somewhere. This is 8%, yeah? Year 1. This is year 2. This is year 3. If I'm not doing it wrong, I hope so. And then you have your present value. So if I take my present value, so times this number. And then I say total present value of tax benefit on bank loan. And that should be a total of the 4 numbers. Guys, if you do not understand, please ask me. So this is 3739.49. It goes here. Here, tax benefit on bank loan. 3739.49. This is the third thing we wanted to calculate. Three things. Anything you want to ask until here, please ask. Okay, so the final thing which we need to calculate out of these four, the final thing is tax benefit on interest saving on subsidized loan. Interest saving on subsidized loan. Because you remember the bank is giving you at 8%. Government is giving you at 3.1% thanks to the government. So you are saving some interest cost as well. So what is the impact of that? So let me copy paste it and I'll put it here. Let me make it black. So this is the final calculation. Again, very simple, logical. How much government is giving you? 80 million. How much are you saving on that? You are saving 8% is the standard rate with the bank, but government is giving you 3.1%. Okay, so this is the saving on interest, saving on the principal amount. Is all of that your benefit? No, 30% of that, which is the, how to say, the tax thing which will go, 30% will, so this is the saving or the gain which you will make. But out of this, 30% will be taken by the government as tax. What the real benefit is 70% to you. Here you should put 70%. So think logically, okay, that this is my savings on interest, which is almost like 5%, close to 5%. I make 5% savings because of the government subsidized loan. So if I just take, can I take all of that savings? No, because 30% will be taken by the government. What is left with you is 70%. Is this 70% or is this benefit only one time? No, it will happen every year, 4 years, because it's the government thing. So the loan, remember, same interest every year, same saving every year. So you need to multiply it with the annuity factor, which is 3.312. I have throughout used discounting with 8%. I did not do any discounting with 3% or 3.1%. For discounting, I'm taking 8%, which is the debt. And then when I take it here and I put it here, I put equals to sign, and it gives me 909 million. That's the actual saving actually you are making. Okay, so if I now put these numbers, I'll take these numbers below and I'll just put them here. So $98 million. And I can make it now black. I don't need it red anymore. So I call it financing side effects. Financing side effects. As a result of financing, what is the impact? The impact is total 12.87 million. Your basic NPV. Basic NPV is equal to 5.147 million negative. And this is your adjusted NPV, adjusted present value. Oh, what is this happening? Okay, so these are numbers in millions. I can put it into 1,000. Okay, I can, so this is like this. Remember, because other numbers we put it in, not in millions. So this is in thousands because I just calculated in thousands. So format has changed a little bit of the question of above and top. So your adjusted present value is 7.7 billion. And they ask you conclude whether you should do it or not. Of course, you should do it. But while doing it, you need to pay attention to two factors. Number one, the cash flows are only given for 4 years, whereas it's a huge investment in electric vehicle plant, which might have a longer period of life. So this is one concern. The second concern, which I saw here, is about the residual value, which was 45 million, because you see, you've got 7 million in present value terms. Project looks very good. Okay. So project looks good, but that 7 million is based on that assumption that you will get this 45 million at the end of the life. What if you do not get this 45 million? What if this plant is sold only for 35 million? Then everything will be wasted. If you lose 10 million here, your APV even will become negative. Now, there is only one point which I wanted to explain you. Question is, part A is solved. Okay, and you can write down 3 lines. It does not require you long discussion. You should say that although the basic APV, basic NPV discounted at cost of equity was 5.146 million negative. However, due to the financing impact of the debt financing, which is 12.817 million positive, and therefore the adjusted present value is 7.67 million positive, and we should accept this project. However, we should consider that this adjusted present value of 7.67 million positive, it depends hugely on the forecast of these numbers about the revenues, which we have expected. If the revenues will change, APV will change. And it also depends a lot on that significant 45 million cash inflow by selling the plant at the end of year 4. And if we are not able to recover this amount, then this APV probably will not stand true. That's all what you need to do. Yes, there is one thing which might come to your mind, Now, it's just like when you are seeing the numbers from a different perspective, or you are juggling the things and you say, okay, why did we do this one? Why did we do this one, this calculation, saving this one? We are paying interest. So at 3.1%. Yes, basic NPV, we use KE, and we did use KE. So somebody asked that we use KE. Yes, we did KE. If you see that cost of equity 12%, and we use 12% in calculation. Basic NPV, we use KE. We did not use WACC. Actually, WACC is not used in any of this question. You don't use WACC at all. The basic NPV used with KE, and the financing impact, we use the cost of debt. WACC is not there. Okay, my question was that why did we use this one? See, we did not calculate any. If you pay attention to why did we make this adjustment? Because we said, okay, we are paying 3.1% interest. Why do we have to show it here separately? Because you started with this number here, basic NPV. Here you did not add any interest cost. An alternative way of doing it is alternative way. If I don't want to do this thing, if I don't want to make this calculation, is there another way? Yes, what I can do, I can take this table, the entire table. I can copy paste this entire table somewhere here, and I will add up here interest cost, subtract interest cost, and then it will give you the tax benefit. You see what I'm saying, that if I don't want to, if I do not understand these because these are adjustment. I started with my basic NPV and then I say, okay, this is the benefit, this is the benefit, this is the benefit, this is the basic NPV, which is based on KE. And then these are the benefits because of financing. Is this the only way of calculating APV? No, I could have done 150 and these numbers and then working capital. And then I could have made some other expenses. I would have said, okay, this is my interest on bank loan, interest on government loan, and then I would reduce my cash flow. So every year, how much interest I pay, I write down. How much interest I pay, I write down. And then I will find out my cash flow after in this interest. And then I calculate my, tax expense and discounting factors. You will get to the number. Because we did not reflect this impact, so that's why we show it separately. Okay, this is the impact. This is my NPV, but it will increase with this benefit, tax benefit on the bank loan, tax benefit on the subsidized loan, and the interest saving on subsidized loan, the present value of that. And of course, this is the cost. So this is actually a short way of doing it. This is a short way of doing it. That basic you already have calculated. Now you just make some adjustments. But otherwise, if you want, you can go for a longer way and you can make a complete table, including the interest which you are paying and the tax impacts because of that interest and the net cash flow. I mean, if somebody would be interested who are really into finance, I mean, this is what I used to do. I always used to calculate things with multiple formats because numbers should hold true. So somebody should try to, at home, somebody should try to make this table without finding out this NPV, this APV without this thing. You can make it with the table as well. Answer will come same. Okay. Coming back to this part, which is discussion factors. I'll give you the answer because I'll provide you the standard answer because right now in the live class, I might not be able to draft the proper response, which you should be seeing given by the ACCA. So it's better. But I can tell you some factors which you have to address. And the structure you will see there, the language you will see there. But the long-term financing, when you say long-term financing, you go for equity and you go for debt. Okay, so how much equity, how much debt? It says that discuss the factors which may determine the long-term finance policy. So finance policy means that what should be the capital structure, how much equity I should have, how much debt I should have. Number one, it depends on the company policy. If the company has certain optimum capital structure ratio that we will have 60-40, 70-30, 50-50, this is the board policy. We don't want to have extra gearing. We don't want to take too much debt. So one is the board policy. One is the capital structure, which brings down, which gives you the optimum or the lowest possible WACC. So first reason is the board policy, the management policy. The second reason is the lowest, achieving the lowest cost of capital, lowest cost of WACC. third factor which could impact is the market itself. If the market is down, when the market is in economic recession, all companies, their shares prices in the market are low. At that time, you will never issue the new shares, because if you issue shares when the market is below, so you are going to actually sell yourself very cheap. When in recession, you go for debt financing, because if you issue new equity shares, they will be issued at a very low price, which is probably not a good idea. Companies, they issue new shares when their shares are at a higher price so that they can collect more finance for the same number of shares. But on the other hand, if the company does not see stable cash flows, they don't go for debt financing, they go for equity financing. If you see some risk associated with the cash flows of the company or profitability of the company, you don't do debt financing, because in that case, you are putting yourself into risk. And probably the lenders will also not offer you attractive rates, because they know that this company is, facing some cash flow instability. So there are some risks for repayment. They will increase the cost of debt. So you don't go. They also do not invite you, and you also do not go. So there are several factors which you consider, like capital structure, lowest cost of capital, market, because this equity debt has to be raised from the market. So what is the situation in the equity market? Then there is another shareholders influence, because if you offer new shares, there is a dilution impact will happen. New shareholders will come in. So people who before holding the 10% of the company, their shareholding will drop down to 8%, because you have issued new shares. They might not be interested in that. Plus, if you don't have cash flows, what is going to happen to the dividends? Prepayments there are there. Sometimes there are some external restrictions. You have some lending covenants that your banks have put you, that you cannot borrow more than that. So there are many, many, many. I'm telling you the academic reasons for long-term financing policy, how much of equity and how much of debt. So 5-6 points I've told you. If you explain every one in two line, it's a 10-mark question. But in any case, I will provide you, actually I have here solution of this question. So you can read this solution. That part I will write down. I will add it here, solution, and you will read it from there so that you get familiar with the proper drafting style for this question. Okay. Anything you want to ask, please ask.